Israel and Iran, two nations long locked in conflict, have once again become the epicenter of a global geopolitical quake. But behind the headlines and gunfire, what do those with deep economic and investment insight see? They recognize this not merely as a regional war, but as a strategic move by American capitalists aiming to reshape the balance of global financial power through a triple-pronged strategy: an oil crisis, a currency disruption, and a supply chain upheaval. As June 2025 marks the maturity of a massive tranche of U.S. Treasury bonds, most issued during the pandemic era with near-zero interest rates, the U.S. government is now forced to refinance at rates as high as 4%. Compounding the problem, the demand for long-term bonds has collapsed, pushing the U.S. toward short-term borrowing, which shortens refinancing cycles and heightens risk. In response, the U.S. has deployed a series of coercive measures, reinstating tariffs to force global investors into buying treasuries while simultaneously leveraging regional conflict to ignite a global energy crisis. The Israel-Iran conflict alone has caused a 36% surge in oil prices in a short period. Even more concerning is the Strait of Hormuz, a critical artery through which over 20% of the world's crude oil flows. Iran, capable of blockading this choke point, now holds the global energy supply in a vulnerable grip. Should the strait be sealed off, Middle Eastern oil flows would halt, pushing much of the world, especially Europe and Asia, into total reliance on American oil exports. This is what investors refer to as a global-scale asset redistribution mechanism. As the world scrambles for oil, it must also scramble for dollars. Rising demand for dollars enables Treasury yields to fall without the Fed needing to cut rates. And as interest rates drop while capital flows back into the U.S., the Fed gains room to print money without collapsing the dollar's value. It's a threefold win. The U.S. alleviates its debt burden, expands financial influence, and draws investment capital back home. Meanwhile, gold, the so-called safe haven asset, has defied expectations. Historical data shows that during conflicts like Syria, the Russia-Ukraine war, and the U.S.-China trade war, gold prices dropped rather than soared. This reveals a global trend. In crises, investors prioritize liquidity and trust over precious metals. The U.S. dollar, as the global reserve currency, remains the preferred refuge. Gold, therefore, appeals more as a long-term hedge against inflation than as a short-term war hedge. Strategic investors like Warren Buffett have already acted accordingly. Buffett increased his holdings in oil and gas stocks, anticipating rising oil prices. At the same time, smart investors aren't hesitant to lock in profits on gold holdings at peak prices, especially when geopolitical tensions escalate, driving sudden surges in dollar demand. Why does this matter? Because as oil prices continue to rise, production, transportation, and living costs across the globe will surge. Global businesses already operating on thin margins will face a wave of demand destruction as consumers resist soaring prices. But American goods, buoyed by domestic energy supplies and tariff protections, will remain competitively priced, gaining a substantial edge. The U.S. doesn't need to lower its domestic production costs, it only needs to raise global costs, something that is clearly underway. As oil prices spike, transportation becomes costlier, tariffs are reinstated, and the dollar strengthens, foreign goods become exorbitantly expensive. Businesses abroad are squeezed by rising costs, while U.S. firms emerge as the more attractive choice. Eventually, global manufacturers must consider relocating to the U.S., not only for incentives, but also to avoid the risks of trade wars, energy crises, and currency volatility. What we're witnessing resembles the lead-up to the Great Depression of 1929, when the U.S. imposed sweeping tariffs and triggered the collapse of then-industrial powerhouse Germany. The American elite didn't go to war directly. Instead, they weaponized economic turmoil to plunge other nations into recession while buying up distressed assets with freshly printed dollars. In today's context, as the world teeters on the edge of stagflation, simultaneous inflation and economic contraction, U.S. policy enables it to win on both fronts. Hoard dollars, lower interest rates, and use those dollars to buy up global assets. Investment strategy in such a landscape demands more than risk aversion. It requires deep analysis of global capital flows. Those heavily invested in gold should consider taking profits at peaks, not because gold has lost long-term value, but because new opportunities are emerging in oil and logistics. Oil ETFs, energy stocks, logistics firms, and even commodity hedge funds could become prime targets. Conversely, airline, shipping, or oil-dependent company stocks could face steep sell-offs, creating ideal shorting opportunities. Tracking major indicators also demands learning to read the weather like institutional investors do. When capital exits gold and flows into dollars or treasuries, when global manufacturing indices dip while U.S. investments soar, when oil prices climb and energy stocks rally, these are signs that trends are taking shape. Markets don't reward those who act on instinct. They reward those who understand the game, who knows who's moving the pieces and why. The Israel-Iran conflict, from a humanitarian perspective, is a tragedy. But in the financial system, it's a chessboard where major players are redrawing the world order. If you're an investor, don't just fixate on today's gold price or tomorrow's oil spike. Position yourself in the broader landscape and ask, where is the capital flowing? Which assets are being accumulated? What trends are forming? And should I ride or avoid them? Because after every crisis, there are always those who are wiped out and those who become millionaires simply by spotting one truth. The trend doesn't lie where everyone is looking. It lies where the big players are already moving. And if forecasts hold true, July will be the pivotal month. When tariffs return, the Strait of Hormuz could be truly blockaded, and the global financial cycle may shift entirely. At that point, it's no longer time to watch, it's time to act.